Good morning and welcome to today's webinar. My name is Luke Yango, and today we have a very special presentation, which is weathering a market correction while in retirement. And what we'll be doing is reviewing the strategies on really how to navigate various market downturns while you're in your retired years. But before getting into the agenda and getting into the meat of today's topic, as always, let me give you a quick overview on myself, my team, and really the specifics to what we do for those that are not clients on the line. And I will say also that we will be talking about some tax related items. So, from a compliance standpoint, do be certain to review with your CPA any tax related information regarding to your specific situation. But to give you some background on us, we're a financial planning and boutique wealth management firm here in Southern California. However, we do have clients across the United States. And what we do with our clients, many of which are on the line with us today, is we work with them on their both financial planning and investment management needs. So we make it a priority to take a comprehensive and holistic approach to planning and also to continuously educate, which is one of the reasons why we host this webinar series as well as our briefing series. Now, our planning process involves building well-designed financial plans, organizing our clients' investments in direct coordination with that plan, and then ensuring that any outside financial planning items have been handled. And that may involve our collaboration with CPAs, attorneys, or other professionals within our client's advisory team. And here's a quick overview of our team. We have 7 advisors in the firm, myself included, a retirement plan specialist, an investment specialist, and then 3 administrative assistants. And I always like to start these webinars by really explaining the planning pyramid, and that true planning does involve an array of varied topics. And for today's conversation, we're mostly going to be focused on how you can achieve really a better sense of security through proper risk management and retirement planning, which ultimately will result in less worry on your end, helping to get you higher and higher on the planning pyramid itself. And there are going to be 5 main strategies that we're going to review with you. But before getting into these strategies, I want to say that whether you are in retirement or nearing retirement, volatility is normal. Market corrections will happen, but there are always strategies worth considering. So to begin, let's just start with the simplest and the most straightforward strategy, which is to review your budget and to review your expenses. And what I want to review here are the do's and the don'ts that you should be considering if you feel as if you're spending maybe too high because of a potential dip in the market, resulting in your portfolio losing value. And the first thing that you want to do, and I want to talk about, is to review your collective spending in relation to what we call the safe withdrawal rate. Now, this is just a rule of thumb. However, it has served many retirees very well. And the rule of thumb states that you can withdraw approximately 4% from your investment portfolio on a yearly basis with fairly high assurance that you will not deplete your entire portfolio. Now, like I said, this is a rule of thumb and your planning shouldn't be 100% based off of this. However, if you review your spending and it turns out that even after your portfolio has dropped in value and you're still pulling less than 4% annually from your portfolio, then you might not need to stress as much. And you might not have to go out and immediately cut spending because you think you're in a worse off financial position. Secondly, it's always a good idea, and this kind of goes hand in hand with the first strategy here, but it's always a good idea to reforecast your long-term planning with the updated numbers after the market drop. Often we see that people just assume their financial plan is no longer sound after a decline in the market. However, what happens often is they see it's perfectly fine after running updated numbers and different scenarios. And from a psychological perspective, it is very hard to see your accounts drop in value, especially when you are retired. But numbers do not lie, and if your financial plan is still appropriate, then there's not necessarily a need for worry. Now, the third strategy would be to consider tactical financial moves that may free up cash flow. Now, everyone is different, but what you could consider here is potentially refinancing into a longer term mortgage to reduce your monthly payment. You could take or talk to a property and casualty insurance broker, see if you're able to bundle certain policies to reduce some premium costs. You could apply for various discounts that are available in the market, especially during recessionary periods. Quite frankly, the list here goes on to free up cash flow. What you don't want to do is you don't want to just go out and make a bunch of emotional decisions based off of fear in relation to your day-to-day spending. Now, if you needed to, what you could do, which is the fourth strategy here, is temporarily remove certain variable expenses. So if, for example, maybe your planning isn't secured given the market drop, then maybe it does make sense to cut out some items. However, what you should never do is stress about many of the fixed expenses that you must pay for. For example, your mortgage, home-related bills, insurance, and more. There's very little that you can do regarding these fixed expenses. So it's usually best to just pay them and to move on rather than worry. And generally speaking, your biggest expense is usually your mortgage. And always remember that with every mortgage payment, you're paying into the equity in your home, which is an asset on your balance sheet. So if you think about it, it's not really an expense. It's more like taking money out of your left pocket and just putting it in your right and paying a little bit of interest. And then the last thing that you can do is you can always review quarterly. And if you've made certain adjustments to your spending, well, you may want to potentially reverse those adjustments once the economy recovers and your portfolio recovers. Do not, and I repeat, do not just assume that whatever adjustments you have made are permanent. So that about sums up the first strategy here, which is analyzing your cash flow. And it leads me to strategy number 2, which is utilizing lines of credit as a retirement funding source. And the strategy here is actually to borrow money to pay bills during significant market corrections through what's called a line of credit, rather than pulling money from your potentially battered retirement portfolio. Ultimately, you do have to pay back these lines of credits, these loans against the lines of credits that is. However, the strategy involves essentially waiting for the markets to recover before paying off the lines, whether that be a few months or potentially a few years, and then paying them off once your portfolio is back or close to back to its previous highs. For example, I had a client who bought a home during the COVID dip of 2020, and rather than paying for the down payment by liquidating her investments, she actually borrowed from a line of credit and paid that line back once the economy recovered. And if you remember anything about 2020, the economy recovered pretty quickly. Now, there are 2 types of lines that I'll briefly talk about, which are home equity lines of credits and securities-based lines of credit or securitized lines of credit. Both lines of credits are very similar in that they're essentially backed by your tangible assets. The HELOC is being backed by your home, and the securities-based line of credit is going to be backed by your non-retirement investment portfolio. Additionally, both lines are typically interest-only and utilize a floating interest rate. Some of the main differences to these lines are that with a HELOC, many times you do have to show income to qualify. So you may want to attach a HELOC to your home while you're still working. Whereas with a securities-based line of credit, generally you don't. And usually with a securitized or securities-based line of credit, you might even receive a lower interest rate because your home isn't as liquid as your non-retirement investment portfolio. And often you get a lower interest rate because of that. So how do these lines work regarding the strategy? Well, let me show you an example. Let's say you're retired, you have $1 million in investments, and you need to live off 4% of your portfolio or $40,000 a year. Well, let's say that we're in a market correction similar to 2008, and your portfolio drops by 30% in 1 year, but then it recovers the next. Well, if you were to pull $40,000 from now your $700,000 portfolio after the market drop, that would result in a 5.8% distribution from your account. Now your portfolio would be sitting at $660,000 after the distribution. Then let's say the economy recovers back to its former highs. In this example, your portfolio would grow to $942,480. So as you can see, by pulling $40,000 during a market downturn, it permanently reduces your portfolio. So that essentially when the market recovers, your portfolio is not able to get back to where it would have been if you pulled 40K out when your account was valued at $1 million. That would be $960,000 of portfolio value. So let's talk about the strategy. So on the right, all of the assumptions are the same. But the only difference in this example is that instead of pulling from your portfolio when the market is down, you actually borrow from a line of credit and you pay 3% interest in this example for the year that you had the outstanding loan. So in this example, you let your portfolio fully recover back to $1 million. Then once your portfolio is recovered, you pay back the loan along with some interest. And that's going to result in your portfolio's ending value being over $16,000 higher than the previous example. Make sense? In summary here, paying interest to borrow money during downturns in the market sometimes can actually benefit you financially. And generally speaking, one of the most cost-effective ways to borrow is actually through a line on your very own assets. If you have questions, write them down. I'll be opening it up to questions at the end, but let's move on to strategy number 3, which are investment strategies to be aware of. And I'm first going to start fairly broad, and then I'm going to get into some of the more tactical strategies here. And the first thing I want to review isn't necessarily a strategy, but one of retirees' biggest investment-related risks, which is the sequence of returns risk. And essentially what this says is that during your accumulation years, so long as you stay invested within your accounts, the sequence of your portfolio returns, it doesn't impact your long-term portfolio substantially compared to when you were in the distribution phase of your life. Because yearly returns average out when you're accumulating and when you're just, letting your portfolio grow. And generally speaking, what matters more is just your long-term average, not your year-to-year return, especially when you're starting, like in this example, with a substantial amount of money on the front end. In the distribution phase of your life, though, the sequence of returns does matter dramatically. Poor performance in early years of retirement results in lower long-term portfolio values due to early distributions, kind of like what I showed you in that last example. And positive performance in your early years of retirement essentially produces the opposite. So let's look at this detailed chart for some proof. Now, this is a very extreme example, really just for illustrative purposes, but it helps to explain the concept. Look at the left side of the chart. 2 portfolios, A and B. They both start out at $100,000 and they receive varying returns. Portfolio A has very negative years early on, while Portfolio B has some very positive years early on. But in the end, they both average to an 8% annual rate of return. Now, if you look closely, the yearly returns for these investors are actually flipped. They're just the same, but they're flipped. You can see at age 41, investor A has a negative 12% rate of return, and at age 65, investor B has a negative 12% rate of return. They're just flipped on the chart. But at the end, both investors end with the same portfolio value of $684,848. Now, when these investors start to distribute, though, things are much different. We're going to use the same rate of return scenario here. So investor A, who had early negative years, ends up running out of money, while investor B passes away with over $2 million. This is due to investors A's portfolio dropping to the point where it couldn't keep up with their yearly distributions, which, by the way, in this illustration, are the same every single year for both investor A and investor B. So how can you avoid this? Well, financial planning, in my opinion, is the best way to plan. But simply put, to lessen the sequence of returns risk, you need to lessen volatility within your portfolio. And how to lessen volatility usually comes with proper diversification of your investments. Because history has shown that various asset classes return differently with different market conditions. And through proper diversification, generally you're able to reduce your ups and your downs in your portfolio. And just take a peek at this chart for some proof. What you're looking at here is a heat map of very varied asset classes and their annual returns from 2008 to 2022. Each column is 1 year, and the asset classes are organized by highest performing to lowest performing. And the asset classes are labeled by color, which helps you, glance over this document and see some patterns. But what you'll notice, though, is that each year the asset class returns vary drastically. Now, there's not really going to be much consistency in returns. However, what you can see is a well-diversified portfolio generally has some consistency. Take a look at that black line tracking that white box. That is a well-diversified portfolio. You'll notice that while its returns do vary, it's generally around the middle of the pack of this chart. Compare this to, say, let's just say US equity here, which has very, very, very fluctuating returns, which would result in major swings in an investor's portfolio value. And many people think that if you diversify your portfolio, you're essentially going to be giving up return potential. But that's just not true. Because over the course of 20 years in this chart, or I guess 15 years in this chart, the diversified portfolio returned an average yearly rate of return of over 8%, which I expect most investors would be pretty happy with, especially those that are retired and maybe are living off of 4% of their portfolio. So how do you position your portfolio then? Well, everyone's situation is different, but there are some general guidelines to follow. First and foremost, you usually want to avoid being too aggressive or too conservative while in retirement. A too aggressive portfolio may result in having significant large swings, amplifying your sequence of returns risk, like investor A in the example I showed you a few slides ago. And a too conservative portfolio may not grow enough for you, resulting in your portfolio dwindling away over the years. How I see it is there's usually a sweet spot for retirees in regard to their investments, and that is generally a more moderate portfolio. Many times as you age and get further into retirement, you begin to pull back on your risk and be less aggressive while still being diversified and still investing in a broad range of asset classes, though. And my biggest recommendation for you all is exactly that. No matter your age, no matter your risk tolerance, no matter your investment experience or expertise, ensure that you're invested broadly across many different asset classes to the direct proportion that you feel comfortable with. Ultimately, broad diversification has been shown to result in less volatility, which also reduces your sequence of returns risk. But I feel like I've hit on the investment-related concept enough. So let me finish this section by discussing some of the more tactical investment strategies to consider when we're in a market correction, which some of the sophisticated investors on the line might really like to hear about. And a tactical strategy, in my eyes, is going to be a more forward-focused strategy on getting higher rates of return. And ultimately, there are many tactical strategies to consider. Our firm, for example, employs many strategies to help improve our clients' yearly rate of return. And dependent on the market environment really is going to depend on the strategy and what you should be considering. But what I can tell you are that tactical strategies vary drastically from market timing. Market timing is essentially taking bets based off of gut feelings or hunches. It's kind of like gambling. While the adjustments resulting from tactical strategies are more or less based off of data and historic trends. For example, during volatile times, often investment interest rates are reduced by the Fed. A tactical strategy may be to reduce the duration of your bond sleeve to avoid locking in low-paying bonds while interest rates remain low. Historically speaking, value companies do well compared to other stock sectors of the economy during recessionary periods. So maybe by rebalancing a part of your equity sleeve to more value dividend-paying stocks could be a strategic option. Wars or geopolitical events sometimes result in certain countries having expectations of poor performance. And as a result, you may want to consider underweighting certain sectors of your investment portfolio due to these findings. Ultimately, there are many strategies to consider, and while I usually say it's best to leave these to professionals, there are some fairly basic ones anyone can follow, ultimately hoping to improve your rate of return. So enough about this section, enough about the investments. Let's move on to the fourth strategy, which is planning for lifetime income and understanding the ways in which you can more or less lock in some guarantee. And what better way to avoid the stress in the market than to know that you're always going to have income coming in? And I won't spend too much time on this section, but I want to start by discussing Social Security and how delaying Social Security may result in a more financially secure retirement with less concerns. And as you all know, Social Security is a government-sponsored benefit which provides you guaranteed income for life backed by the US government, of course. But what many people don't understand is that there are some significant advantages to delaying your benefit. First off, only up to 85% of your Social Security benefit is taxable federally, which means that no matter what, 15% is going to be completely tax-free. And most states don't even tax your Social Security benefit. So the larger the benefit that you have, the more tax savings you're going to receive in retirement compared to, let's say, withdrawing from a pre-tax 401k or a pre-taxed IRA, which, as you know, is 100% taxable federally and state. Secondly, your benefit grows by about 8% each year that you postpone withdrawing it, up until age 70, of course. So every year that you wait to withdraw, you're essentially locking in a larger benefit. Additionally, you also get a cost of living adjustment each year based off of a percentage of your benefit, not a flat dollar amount. So for those that have larger benefits from the start, they also receive larger cost of living adjustments. For example, if I were to withdraw at age 62, you were to withdraw at age 70, and we both have the same Social Security benefited, full retirement age, your benefit's going to be higher. We're going to get the same cost of living adjustment as a percentage of our benefit, which means your higher benefit will result in a higher cost of living adjustment each year. And then lastly, if you are married, the surviving spouse receives the highest of the two benefits, and they keep that benefit within the family upon the death of one spouse. So in summary here, by delaying when you claim your Social Security benefit, you are going to essentially lock in a larger benefit for life and potentially for your spouse's life as well, with larger cost of living adjustments to help account for inflation, and you have a more tax advantaged retirement benefit. Ultimately, by having a larger benefit, you may have significantly less stress and worry regarding the ups and downs of your portfolio value, and ultimately may just need less money to withdraw in retirement then. The negatives to all of this, though, is that you will have less cash flow prior to claiming, of course, and if you were to pass away early, money may have been left on the table. But if you're in a situation where even having the guarantees of Social Security is stressing you out, then there are other options. And another option is to essentially purchase a pension, which can be purchased through what we call a lifetime annuity. And annuities have historically received a very bad rap by the general public, but in my opinion, annuities are just a tool that can help to provide an enhanced level of security, resulting in less stress. And think of a lifetime annuity as essentially longevity insurance. You pay a certain amount of money to have a stream of income for life, guaranteed by the insurance company, and the benefits are fairly obvious. You're going to have a certain level of guarantees, a steady flow of money, and it may feel as if you never run out of money. And I'm sure that sounds nice to everyone on the call, but there are still negatives to this type of planning. The largest negative being that annuities cost money. They are insurance products designed by big insurance companies. And because of that, they do have limitations. Additionally, your money is only guaranteed by the claims paying ability of the insurance company. So ensure that you are using an insurance company that is highly rated. But what I'll say is that if your situation calls for an annuity, let's just say you can't sleep at night due to the consistent worry that comes with investing in the financial markets, then products like these could be a good option for you because they are designed to reduce stress that you may experience in retirement. And ultimately, you can build them into your financial plan, but they're not right for everyone. So just be certain to talk to a financial advisor or a financial professional about the pros and the cons to a specific product that you might be interested in. And that leads me to the fifth and the final strategy to consider, which is having a living, comprehensive retirement plan. A retirement plan is essentially your roadmap to retirement. It ensures that you have clearly thought through your financial future, helping you to navigate retirement with confidence, clarity, and comfort. And what a financial plan can help to do is it'll help you account for much of what is shown on the right here. It'll assist with cash flow management and inflation, retirement forecasting, planning for risk, ensuring your investments are managed appropriately. It'll help you think ahead and ensure that your estate transfer goes according to your wishes. And it will essentially give you financial visibility into the future. So what I'm going to share with you now are our firm steps in building a retirement plan. And that is exactly what we do for our clients. And what we found is after taking the necessary steps, people a lot of times have more confidence in their future, resulting in significantly less stress. And the first thing I want to do is to review, or the first thing that you want to do is to review essentially your goals and objectives here. In our eyes, plans should always be focused on achieving your vision, as it allows you to plan tactically given whatever is most important to you in life. So once identifying your objectives, you should get organized and review your balance sheet and current and future expenses. Ultimately, what you're trying to do here is build out an appropriate model that not only takes into account where you're at today, but also where you're headed. And we always want to plan conservative and account for variables that are unforeseen, because ultimately we don't have a crystal ball. We don't know exactly what the future holds. So rather than planning using, averages, for example, average inflation numbers or average rates of return, we want to plan using more conservative assumptions. Use a higher inflation number in your plan and use a lower rate of return in your plan. And lastly, like I mentioned at the beginning, it's important to review and to adjust the plan to ensure that you stay on track, because no plan is perfect and your plan should be adjusted every year or two. Now, this is just a quick example of what your financial modeling might look like. As you can see, you want to organize your financial life by listing out various accounts, benefits, expenses, and much more, and then begin projecting outward. That'll give you an idea of what your retirement may look like, let's say 5 to 10 years in the future. It is not glamorous, but it does provide you much of the clarity that you need to ensure that you're headed in the right direction. Next, I always recommend that you do a true analysis of your investments. Just like I talked about before, your investments are a key driver of your long-term financial planning, so ensuring that they are in line with your plan is very important. This is just an example of what an analysis may look like, but what is important to know is that you are not trying to analyze each and every fund or each and every stock. Leave that to the professionals and the experts. What you are trying to review high level is what asset classes you're invested in and what you are not invested in. Ultimately, you need to identify investment-related gaps and determine what changes need to be made. Now, there's plenty more that goes into building an appropriate plan, but if I reviewed all of this or all of it now in this webinar, it would probably last another hour. So I'll close by saying this. There's only so much that you can control. Market corrections, bear markets, volatility, whatever you want to call it, it's extremely normal and it is expected. But what you can control is how you react to the markets. Watch less news. Watch more educational events like this. Focus on your planning. Review your portfolio. There's plenty that you can do, but just don't focus on the stuff on the outside of this illustration. You'll have less stress and overall more happiness if you do so. So with that being said, thank you all for joining. If you have any questions, please reach out. For the clients on the line, know our door is always open. If you'd like to talk, rerun your financial modeling, review your investments, we're always here, and you do not need to wait for us to schedule a meeting. And for those that are not clients, if you have questions for me, if you would like to talk offline, or to talk about what building a plan with our team would look like, my contact information is here. You can reach out to me directly or reach out to us on our website. But what I'm going to do now is open it up to a Q&A. And for those watching the pre-recorded webinar, I do need to close out in advance of the Q&A. So if you are watching this and have questions, like I said, reach out. I'm happy to help. But let me close out, and then we'll get to the Q&A. Thanks for joining, everyone.